Good morning, everyone. Happy Thursday. Welcome to today's episode of Morning Wealth. Three things that you can look to hear in today's episode. European Union 750 billion rescue package, Trump's threat to Twitter, and Swiss National Bank's FX intervention. The US stocks surged on Wednesday, climbing to levels not seen since early March on optimism that economic activity is gathering steam and authorities may offer more stimulus to bolster the recovery. Dow Jones Industrial Average rose 550 points or 2.2%, marking the first time since early March that the blue chip index closed above the 25,000 mark. The S&P also climbed for the third day. Nasdaq rebounded from an early deficit after a positive forecast from Micron. The sector rotation story continues. Financials and industrials were the big drivers, with financials up about 4.34%. In fact, all these sectors on the S&P 500 were positive, but the drivers were financials, industrials, and real estate. The yield on the 10-year treasury in the meantime fell 3 basis points to about 0.67. The WTI fell from nearly a 3-month high as investors weighed whether Russia will agree to an extended output curb when OPEC Plus meets in 2 weeks. Gold futures slid close to 1700 an ounce, but then it rebounded, moving towards 1710. The US business outlook remained highly uncertain and most contacts were pessimistic about the potential pace of recovery. This is according to Fed's Beige Book survey that came out yesterday. Some Fed speak as well. St. Louis James Bullard said April was likely the worst of it, while New York's John Williams said we are close to a low point and he expects a pretty significant rebound in the second half. Meantime, President Trump threatened Twitter and other social media platforms after the company started fact-checking his posts. The president said he'll strongly regulate or close them down for silencing conservative voices if they don't clean up their act. What happened was a pair of his tweets that made unsubstantiated claims about mail-in voting were appended with links to a page that offered facts about the ballots. So in all this exchange, Twitter shares fell by about 2%. Japan, in the meantime, is preparing another monster fiscal stimulus package, is rolling out 117 trillion yen or a $1.1 trillion package of easing equal to 6% of the gross GDP, a month after announcing the previous round of stimulus. Hong Kong is no longer politically autonomous from China, is the view that US has. The change in status could have far-reaching consequences on the city's special trading status, leading to tariffs and visa restrictions on some top officials. That's your macro roundup. Moving on to equities, Boeing unveiled the first and the deepest of its planned job reduction, saying that it would let go about 6,770 employees in the US this week. In a surprising move, Lufthansa's supervisory board held off accepting the 9 billion euro German bailout in a surprise move, protesting EU conditions requiring it to surrender takeoff and landing slots. The airline said the aid proposal needs to be analyzed intensively and didn't immediately call for a shareholder vote. Bill Ackman exited his investment in Berkshire Hathaway, as well as his recently acquired positions in Blackstone and Park Hotels and Resorts. Brian Moynihan expects Bank of America traders to do very well in the current quarter. So combined bond and stock trading revenue may rise in the high single digits or even close to 10% from a year ago, is what the CEO said. While many companies are scrapping guidance, Micron actually raised its revenue forecast. Sales will be in the range of 5.2 to 5.4 billion in the fiscal third quarter, up from the previous range. So the CEO Sanjay Mehrotra said cloud computing providers are ordering more memory chips to help their data centers handle surging online activity. Earnings that we can look forward to is Nissan Motor, Salesforce, Costco, TD Bank and Dell are some of the earnings that we can look forward to today. A lot of central bank bond buying is seeing capping long-dated yields, which will bolster the valuation argument for equities. So central bank efforts to support corporate credit is also resonating well with equity sentiment. This is as per an analysis from Financial Times. Moving on to rates, New York Fed President John Williams said policymakers are thinking very hard about targeting specific yields on treasuries as a way to ensuring borrowing costs stay at rock bottom levels. In the meantime, bond investors cautiously cheered a proposal from the European Union to issue centrally backed bonds for the first time. So EU's Commission on Wednesday proposed a borrowing of 750 billion euros from capital markets to offer grants and loans to the most beleaguered nations following the coronavirus pandemic. The new program, which is sure to secure the approval of the 27 EU members, could see the introduction of a common European bond backed by all the states. Investor appetite for risk assets climbed after this announcement. Bonds from Southern Europe, debt-laden countries, which have been among the hardest hit during the pandemic, rallied. So the yield on the 10-year Italian bond dropped to 1.52, the lowest since the beginning of April. Yields on the Spanish and Greek debt also dropped to the lowest level since March. On the FX side, some quick updates. The Swiss National Bank is willing to intervene more strongly in the currency markets amid high demand for the franc. Thomas Jordan, the president, said. He also warned of slightly deflationary environment and noted that he doesn't expect a rapid recovery and said more measures need to be taken. For the first time in nearly 8 weeks, Euro USD broke through 1.10. Since the German and France proposed their recovery fund, market will now look forward to ECB's monetary policy announcement next week. Sterling was the weakest currency, falling sharply against the US dollar and the euro. Talk of negative rates continues to suppress the currency, and UK remains committed to the December 31st Brexit, according to the spokesperson of UK Prime Minister. That's about it. Thanks for your time, and stay safe and healthy, everyone.